All right, good deal. Well, thanks a lot, Brian. Appreciate that, and we are excited to do this full-on interview with Anne-Marie Baiynd. She's the author, which you should see on your screen there, of the trading book, A Complete Solution to Mastering Technical Systems and Trading Psychology, which I had the pleasure of reading. It's it's a really good book. Highly recommend it. I just found it to be very honest. Those of you who listen in on a lot of the NetPicks webinars and our presentations, that's kind of one of the things that we always try to get across, is sort of the realistic vision of what trading is. We at all costs try to avoid that it's easy, it's get rich quick, etc. And I think Anne-Marie does a great job in sort of laying out the path that you can take to become successful, but not ignoring the fact that it is a major challenge for most people and most retail traders. So with that, Anne-Marie, welcome to the interview.
Thank you very much. I'm excited to be here.
Great, we appreciate that. So what I'm going to do is I'm going to be firing off some questions at you, Anne-Marie, and then we'll sort of take it from there. And I also want to tell the people listening that you can ask questions. Usual format for us in the GoToWebinar. Feel free to put those in any time, and then I'll make sure that we save some time at the end for some Q&A, and we'll read those out, and then Anne-Marie will answer those for all of you, so we can make this interactive. But I thought one of the the logical places to start, of course, is just give us a little quick background on you, really what you did before you started to trade. We all had a pre-life to trading, and maybe what was the major inspiration that got you going down the trading path?
Sure. Well, I went to school and got a couple of mathematics degrees, mathematics and statistics, and I began work actually as a neuroscience researcher, working on something having to do with intractable epilepsy. I thought, I'd be doing something great. I'd be helping people that I thought really needed help. And it was a very, very interesting line of work, but it paid very, very poorly. And literally, I make a joke about it, but seriously, I ate ramen noodles and felt like I was doing something great, but, not really someplace where I could actually build a career for myself. And I come from a family of entrepreneurs, and so it's never been the motto of if it's to be, it's up to me was certainly something that I grew up with. And so I was working with a lot of technical people, and I bumped into a gal who said, listen, I run a recruiting company, and I'm looking for somebody who can talk that lingo. I'm looking for technical folks. And I stayed with her for a few years and decided I was going to open up my own recruiting company, and did that for about 14 years. But recruiting is a very intensive business, long hours, and very contractually heavy, and interrelationships that really taxed me personally. And I'm not particularly outgoing individual, a little bit unto myself, and so it was extremely mentally taxing. And after 14 years, I was fortunate enough that the business had done well enough, and that my financial situation was a space where I could say, I can pretty much change and do anything that I want. And so my husband and I'm not really quite sure how we got to this, but he was taking some of his staff to a Success magazine event with all these folks come in, and I sat down and watched my first exposure to technical trading analysis. And frankly, I looked at it and went, oh my gosh, this is easy. Now, prior to that, I couldn't even spell the word stock, and had really quite the aversion to the business and finance world because it just wasn't my thing, right? But I saw it and I thought, wow, I can use all my education from a technical perspective and really learn something neat. And so I just absolutely flew right into it. Absolutely went from 0 to 60 Problem is, I didn't do that vastly important thing called paper trading, and because I was a person that really had a lot of personal confidence about what I could do as an individual, because I had done some really good things, I thought, you know what, this is going to be easy for me, and because I was good at this, I'm going to be good at this. And it's not really like that at all. For some reason, the trading world has a totally different conception of any other vastly difficult, with lots of moving parts kind of career. For instance, an attorney, you wouldn't come out of law school and then a year say, okay, you know, now I'm running a $15 million firm. But somehow in the trading world, we think that we can jump from 0 to 100 and have all the trappings and all the success and everything right away. Right? Yesterday I was in the trading room and I said it's sort of like thinking that you can go out and rob banks for 3 years and then decide you're going to quit because it's just some way to, you think you're going to get rich really fast and then retire on the French Riviera. And it's not like that. It is a complex mechanism. And there are many folks that spend a lifetime trading, and it takes them a lifetime to amass the kind of wealth that they're looking for. And many folks sort of fall into trading thinking that, you know, they're going to hit the mother lode. And I, unfortunately, was one of those folks. And so I jumped right into real trading. And the truth of the matter is, the only reason I was able to last was because of the amount of money I started with. And really, I lost a tremendous amount of money before I put the brakes on and said, hey, listen, you know what? You do not know what you are doing. And until you figure it out, you need to start working with paper money instead. I know that was a long answer, but really was kind of a convoluted way into where it is that I got where I am.
Yeah, no, it's always important to kind of know people's paths. I will tell you, you know, we're probably all a little disappointed because one of the things that we use to promote the webinar is that if they listen, they would be able to retire on the French Riviera. So are we saying that that's actually going to be a little bit more difficult than just listening to the webinar?
In 12 months, yes, just a hair.
There you go. There you go. Well, I like your background. I think one thing that's interesting, the fact that, you know, you were a neuroscience researcher and you're like, hey, I'm really good at this. I should be really good at trading. And, you know, for me, I mean, my background was really just, you know, sales and marketing. It doesn't quite live up to neuroscience, but came into it the same way. You know, hey, if I'm really successful in this pre-career, then obviously trading, come on, how hard can it be? And
Exactly.
obviously, as we know, it's it can be quite difficult.
Mm-hmm.
Early in the book, you had a description of how you talk about the retail trader, which I liked, and you said the retail trader is like that great kid from Pop Warner League, full of promise and burgeoning skill, stepping on the gridiron. Only our opponents are the Pittsburgh Steelers. One of us, all of them, and for our international folks, Pop Warner is just the kids football league. So, you know, when I read that, I was like, okay, that was early in the book, and clearly for the new trader, that seems pretty overwhelmingly daunting. You know, how do you really stand the chance to persevere? I mean, knowing that's kind of what you're faced against as the starting retail trader, I mean, what was sort of the thing that got you to persevere through those challenges?
Well, for my temperament, I'm a bit of a never say die person. But if I weren't, I would think that the major thing that the newer trader needs to realize is that you must know who your competition is, right? I mean, if we use the sports analogy, right, what we pay coaches millions and millions of dollars to sit down and watch film all week and say, oh, no, no, when these guys do this, then we need to do this. Trading is no different than that. In order to win, we must know our opponent. And many of us come in with that overconfidence that, no, 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 I don't need to know all that. I just need to know X, Y, and Z, and that's all I need to know. And the fact is, when money is involved, people will become extremely ruthless, at getting what it is that they want. So I think more people should be fearful of entering the trading world, only in the sense that they must learn that their capital needs to be preserved, and they need to put a watchful eye on it, and they need to know that every time they put it in the market, someone is there to take it. And in any transaction, there's always going to be a winner and always going to be a loser. And if that's the case, you need to decide beforehand which one you would like to be, as opposed to going, oh yeah, this looks good, I'll do this. You know, so we must, as traders, we must become more discretionary about how it is we allow ourselves to be exposed in the market. I think the management of risk, or the mismanagement of risk, is the one primary reason that people cannot make it in this business. I coach all the time, and I have some very talented students who do not know how to manage their risk, and invariably, if they don't learn that skill, they're out of the game. And the only way you can learn to manage that risk is by knowing your opponent.
Yeah, I would agree with that. I mean, it's interesting because something that we do say a lot to people when, we're doing our trainings as well, is that our experience always is usually, and it's not always, but usually the people with the very large accounts, they talk to us a lot about the risk and the percentages. They don't even talk hardly at all about the profits. And the people with the smaller accounts are always the ones that come to us and want to know if and when they can double their account, and can they make $500 per day, with the $1,000 starting balance. And all they talk about are the profit side, and don't make any mention at all of the risk. And we try to point out to people, there's a reason that the guy with the big account, all he talks about and cares about is risk, and there's a reason the person with the small account, all they talk about is profit. So, I mean, that's the point that we make.
Yes, that is spot on.
I was trying to think, what was one of the things that sort of made me sort of persevere, because I faced all the same challenges. I did everything wrong that you could possibly do, and I was like, I know I'm really competitive. I hate to lose. I think, when you talk a lot about some of the, the references to being an athlete, that's obviously something that motivates people, but I also know I'm really stubborn. Mm-hmm. And I hit a point in the book where you were talking about, what if you suffer from the right all the time disease, and you said being stubborn does not help you make it in the market. In fact, it often breaks you. And I've kind of thought sometimes, like, well, I think my stubbornness has motivated me, but if I think a little deeper about that, it may be something that's really gotten in the way. Either the right all the time disease or that stubbornness. I mean, kind of, what's your take on that?
Well, there's a fine line there, right? Because you do have to be willing to take those slings and arrows in the market. You have to be capable of handling the punch in the gut. But that's different than a sense of being stubborn versus the sense of always wanting to be right, are maybe a little bit different. And here's what I mean by that. It is okay to get punched in the face and then get back up, and get punched in the face and then get back up. That is absolutely a great ability. Not a lot of people have that ability. But to get punched in the face, to get back up and go, no, I'm absolutely right, there's nothing that I did wrong, or stay in a trade so long because you're so sure that the market is going to turn around because you're so right, that's the problem. It's not the ability to persevere. It's not the ability to stick to it. It's not the ability to get up after the worst day you've ever had in your life and come back. What's worse is, hey, I don't reevaluate because, hey, I'm always right. And that was the problem I really had. I was so certain that I was right. We have a tendency to create cognitive filters, right? So if we like a person, we're going to ignore a lot of the bad habits that they have and overlook them, just the same way as if somebody would come and say, hey, Bill over there, I don't really like him because he blah, 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 and you get introduced to Bill, immediately you've got a cognitive bias against him because your ear has been filled with all of that stuff. So that cognitive bias forces you in a space where you go, you know what, I'm always right, I'm always right, I'm always right, I'm always right. And if you don't reevaluate what's happening in the market when the market shifts, you are going to get trounced.
Yeah, I definitely think that's the case. You definitely have to have the right, the right focus, the right mentality for trading. Let me ask you, kind of based on that, 'cause I would assume some of your decisions based upon sort of you as your personal profile determines a bit what markets you like to trade. So maybe so the audience has an idea of, like, are you a stock trader, or a futures trader, or a forex trader, or a day trader, or a swing trader? I mean, right now, where's Anne-Marie trading? And do you think that that may evolve, certainly since we're at the end of the year, into 2012? I mean, what kind of plans do you have for next year?
That's a good question. Because I am primarily self-taught, the system that I built works in every market, but I built it on the futures, right? The E-minis is what I built the system on. And so here is my philosophy. My philosophy is that when you approach the market as a technician, you've got to have tools in your toolkit. And so what the market is doing dictates a little bit about what tools I'm using. So for right now, because we seem to be sitting in a bit of a wide range, I'm sitting in a complex iron condor in the SPY. I use options a lot. I use options when I'm a little bit uncertain about how much I want to risk in the market. And I also use options to capitalize on time decay and volatility. So I've spent a lot of time studying those, and I'll take those out of my basket when it is that I feel that the market dictates that. And right now, that's what I'm seeing in the SPY. I manage several types of accounts because we have a number of different holdings. Some of those are swing, and some of them are day. I have one particular account I use to trade during the day, and many times I will trade the TF, which is the Russell 2000 Index Minis. I like them because of the massive leverage. Of course, that makes you hate them once in a while, but
Sure.
I do like the TF a lot. And I have a core group of high beta stocks. Those are things that move a lot. And so those would be Apple, they would be Amazon, Google, things like that. And I only have about 5 or 6 of those. And then my next favorite to trade is the 6E, which are the Euro futures. Really, really like those again because of leverage. I stay in a very small group, trade maybe 10 things max, no more than 2 things at a time at any time from a day trading perspective, because I like to keep focused. And so I look for the charts that I understand so that I know the levels when they come into them. I know what they're supposed to do. If they don't, I'm looking for why. So I live in a comfort space. A lot of folks say, you got to trade over your comfort zone and all that sort of thing. You want to get better, but for me, I trade well if I know the instrument that I'm sitting in. And that means I'm very comfortable with the pattern formations. And so that's what I do. Now, as far as next year goes, what I'm trying to do with folks that I talk to is say, hey, listen, I have a general negative bias on the state of the market. However, what I really think we're in right now is a butterfly formation that's really going to push us up into the 1300s before it rolls. So I don't know when that's going to happen. And if it does sit that way, then all the iron condors will be gone. And then I'll move into something that's a little bit directional that gets me up into that space before I reevaluate and say, okay, is this actually what's happening? Am I still right in this analysis? What do I need to do about that? And so on and so forth. So what I try to do is just sit back and go, okay, what is the market telling me? And then at that point, when it's told me, I will take a position. I do not I let someone else take the risk. I give up the opportunity cost for reward, but the balance of that is that I've minimized my risk and exposure in the market in a space where it's in a pivotal sense, and somebody else gets, if you want to be at the very bottom of that and catch the bottom there, that's great. I'll wait until it stabilizes a bit, and then I'll, hop in and just get my big chunk out of the middle and then leave before I think it's getting to the top.
So it sounds like a lot of what you do is big picture trading, obviously, and then as well as sort of the active day trading. But I know you mentioned in the book that you're a big believer in looking at multiple time frames. So it almost sounds like the positioning between your different accounts, you sort of take that same approach.
Exactly. That's exactly it.
I have a question for you on some of the things you mentioned. I mean, we're huge fans of the high beta stocks. You probably named three of the ones that all of us love to trade and trade actively, whether we're day trading them or swing trading them.
Mm-hmm.
On the futures side, you mentioned the Russell E-mini, which has been sort of one of the core futures markets for NetPicks for a number of years, even before it changed exchanges. And we always have this debate internally as well as with customers. Basically the Russell E-mini versus the S&P E-mini. So do you have any opinion on that, or just any opinion in general on the S&P E-mini?
Well, I think both of them are actively manipulated, right? But I do not advise newer traders to dip their fingers in the TF unless they are very solid with their technical analysis. Only because if you are on the wrong side of that trade, it can absolutely decimate you if you've got as few as, 4 or 5 contracts, right? I mean, they can just ruin your day. And so for the ES, because the leverage is a little bit less, right, that it's a space that maybe folks can sit in if they're learning to work with the futures with real money after they've done it paper trading and so on and so forth. It depends for me. Some days the wicks look too long in the TF and I go, I'm really sorry. I do not want to have a 4-point spread there for my stop, so I'm not playing with you today. And so I look at the ES and I'll do the same thing. And if both of them have long wicks, I say, I'm not playing in that high leverage space. I'm going to look for someplace else where the wicks are just a little bit smaller, a little bit tighter, and I don't have to worry about having such a wide stop loss, not chewing my nails or anything when I'm in a position.
Right. Yeah, I mean, we've always kind of felt the TF in general, like you say, you do need a little bit more margin. It does tend to trade a little bit smoother, and I
Yes.
kind of find a lot of new traders in the ES I would totally agree with you. Feels like you're risking a lot less per trade because you kind of are, but it can be very challenging many times just to get filled when the ES hits certain price levels, whereas the TF typically, right, if you have a limit at a price, 90% of the time easy fill. Whereas in the ES, you sit there and watch it bounce back and forth, back and forth, back and forth.
That's true.
I think that gets people frustrated. I guess the same sort of question on, you mentioned the 6E and you're doing the Euro futures. Have you traded at all in the spot Forex markets or really tried to stick with the futures-based Forex markets?
I have traded with spot, and I did it for a little bit. I really liked it. It's fun. My problem began to be, well, how much bandwidth do you have, Anne-Marie? Can you actually pick some spaces and sit there? And so what I decided to do with the Euro, until it's become completely disconnected, I used the Euro and the bonds to help me work out the timing of where it is I see rotation coming in the market. Is this going to be relative resistance? Is this going to be support? Can I confirm it? This, that, or the other. And so I sort of stick in the basket where they sort of go together, as opposed to just operating in Forex, where I would really have to leave these instruments alone in order to completely focus on that environment. So I normally stick with the futures.
Okay, so you like to have some of that correlation between the markets that you're trading.
Exactly.
Got it. Now I know you're primarily a technical trader, and if I understood correctly, some of the major indicators that that you use are the exponential moving average, the simple moving average. I know you talk a lot about moving average crossovers, and I think it was Bollinger Bands, and you use Fibonacci a lot. Does that still kind of make up the Anne-Marie trading system?
It does. What I've had to do, to clean the charts up a little bit since people watch me trade all day, it just gets a little messy for them if they're newer. So I will leave the Bollinger Bands off and then focus on them. Frankly, price is so important that you can work with the fibs. Here are the primary things that I use. If I'm looking at super short time frames, I will look at the 50 and the 200 simple moving averages. And I love the stochastic momentum index. I think it's a fantastic indicator. Not a whole lot of platforms have it, but Thinkorswim does. And it's a very, very good indicator of what's on the horizon. And here's the thing. If a moving average is flat, and I see my price drifting further away from that moving average, it's got to bounce into it. So I'm always looking for that relative area of support, which I'm going to find with my fib, and I'm going to know, hey, listen, I'm coming up to test that 50 today, right? At least once a day, sometimes twice, we test the 200 on the 5. And so those two moving averages, nice and easy. Just so long as we have those parameters of, okay, where's relative support and resistance, those are the things you really need only to focus on definitively. And so, short answer, yes, those are still the core things that I use. Maybe Bollinger Band a little bit less, stochastic momentum index a little bit more. It really depends on the day. If I look at the stochastic and it's not behaving well, or it's sitting in a neutral zone, I'm not going to mess with it at all.
Sure. I mean, one thing you point out in the book is that trading is not cookie cutter, and a lot of people try to come into it. That's really what they want. I think I've got like the quote you say: "The day is never as simple as the if-then statement." If you're looking for that kind of roadmap in trading, your search will be exhausting, never-ending, and oh, by the way, an exercise in futility. So it sort of sounds like you are you adapt to the day, to what the chart is showing on that given day. I mean, you've got your core indicators, of course, and your core system, but it sounds like you have to be flexible day to day.
That is very true, and I think that is the most difficult thing for
Sure.
folks, because it seems to have so many moving parts. They want, see, in the end, we all like things to be stable, right? We don't want the friend that's a Looney Tune that does things we go, okay, where did that come from? We want things to be stable. We want our chairs always to work when we sit in them. We want our computers to work. And so we sort of force that mentality into the trading space, where really it's like a river full of fish. They're not always going to sit in the same place. Well, that's not exactly true. If you're a trout fisherman, you're going to know that they sit in a certain place all the time. But you know what I mean. Generally, they're going to be here, there, or wherever. And you've got to say, well, wait a second. What's the wind? Is it overcast? And I am a big fisherman, which is why I'm using this analogy. So you've got to be a little bit more flexible in terms of what you're looking at, and so many of us just don't know what we're looking at that seems almost impossible to do.
Right. I mean, I know you point out how important the slope is in trading, especially if you're doing any kind of momentum based trading. I guess it's the same thing, being able to look at a market, determine that the slope of the move up or down isn't there, and even though your indicators might be firing a trade, because they're not going to stop firing trades, I guess
Correct.
pulling back and not being in the market is something you need to do, but obviously quite difficult for people.
Exactly. That's really true. And you've actually stopped on a point that is incredible. We think that because we look at the markets and because we look at the charts that we have to be in a trade, and that is just simply not true.
Yeah, I mean, I think people feel like, hey, I'm trading from 8 to 10. That's what I'm here for. I'm supposed to have 5 trades. No matter what the market's doing, even if FOMC is about to come out or whatever and it's not moving, I'm going to get my profits. And unfortunately, it doesn't tend to work that way as much as you want it to. With the Fibonacci's, I know that's very key for you in trying to sort of determine what's next to happen in the structure of the market. And I remember you mentioned there were a few key levels, and you pointed out some percentages. I think you said like the 100% level and the 200% level are almost always at least temporary reversal points. Then you also mentioned like your golden ratio, the 61.8. I know we've got some fib people, so maybe talk about this a bit, so kind of what your favorites are.
Sure. For fibs, here's something very interesting. If you take a look at the ZB, which is a 30-year Treasury bond futures, right? You'll notice that it really pays attention to a 50% fib, which is why I say, hey, listen, focus on a stock, take a look at it, understand it, because it's going to have a trading personality. Based on all the algorithms that are trading that, they're in pockets, right? So the people that trade in the ZB aren't necessarily trading Google, right? And so there's a different kind of temperament associated with that. That being said, overall, here's how market formations work. If something is in a trend and it's in the middle of a pullback, if it pulls back lightly, it will pull back to 38.2 and then begin to move forward again. If that 38.2 level holds and it begins to bounce, you know that the trend that you're moving in is very strong. The deeper the retracement levels, the weaker the overall trend is, or the more conflicted the traders are in that particular chart. So you can see that in terms of saying, all right, well, I'm in a bit of a conflicted chart. It's retracing 78.6% every single time. So I'm going to have to be careful about where I put that stop level. So it's about paying attention to what's happening in the formation specifically. So let's say we're looking at Google right now. Google's in a very important space. It broke out over that 618 a few days ago, and it's continuing to power forward. It's using a 61.8 retracement level because it's doing so well moving forward. That's the standard, okay, I'm going to take a breath to here and move forward. There's a very specific pattern called the ABCD pattern. A lot of folks use it in Forex, but I find it works tremendously well in the general market, and it assumes a 61.8 pullback and then a 1618 projection from the initial wave. And so when we look for that, everything's nice and structured. So if we are fortunate enough to see something pull back to that 61.8, we see it's in an uptrend, we don't see anything breaking down underneath, we can project out to that 1618, which I love. Now if I'm working with the futures, we have the Globex high and low, and as we move out through the day, here's something very interesting. Happens 95% of the time. If we come into the open within 2 points of the Globex high or the Globex low, we will rapidly accelerate away from it, either in the positive way or the negative way, right? It's going to move. So watch those moving averages and then watch those fibs associated with the Globex high-low. If it projects over, like it breaks out of the Globex high, it's going to come back and retest, more than likely. Sometimes it takes 2 hours to do that, and so you can chase it out. But sometimes it'll do it in 15 minutes, and you can bounce right back. It'll go into the 127.2. If it holds 127.2, it's going into the 1618. Clockwork, day, 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 day. Now the problem is the retracement levels that we've been forced to stomach over the last weeks, they are so long and the wicks are so hard and so heavy that it's almost like a bunch of stop hunters are out there looking to blow us out, which luckily I use mental stops, so that doesn't normally get me until, you know, the mental stop really does kill me because I'm having to chase it out of the trade because it's just gone crazy in the other direction. But those are the kinds of things that I look for. But in the futures, 127.2, 1618. In the general trending stocks, I'll look for that 61.8 and 161.8.
And I guess that's why, like you mentioned earlier, it's really important to get to know a limited set of markets, because you're sort of describing some behaviors that these markets seem to follow on a regular basis, and I'm sure that comes through observation and you sticking with these certain markets.
Very true.
One thing that I noticed you talked about quite a bit, and probably some of it has to do with the ability to sort of create some structure in the markets, maybe with the Fibonacci's, is you do a lot of scaling in and scaling out. I think you mentioned that you don't typically go in with full margin when you're initially establishing a position, and you seem to actually even try to sort of sell into some strength on a buy and then rebuy it on a pullback. So I mean, is that still the philosophy you follow, and would you say you're a scale in, scale out, scale in, scale out type trader?
Absolutely, I am. Absolutely, I am. Here's the reason. My goal, because I learned how to lose a lot of money, my goal is, hey, listen, first and foremost, how can you minimize your risk and maximize your profit? And again, that's all around framing the trade, getting your fibs in the right space, and so on and so forth. But for me, depending on how many conflicting signals I might have sitting around, or how much overhead resistance is sitting, I will say, okay, I'm going to go half size or I'm going to go quarter size. When it gets into a particular space, if I've gone half size and it starts looking a little weak, I'll go back down to quarter size, clean profit off the top. Right there, my money's out of the market and I'm sitting in that one space. If it fails and it comes into support, I'm out flat instead of down for the most part. If it bounces, what I've done is give up an opportunity cost of having twice the size, because as my original position, which was initially half size, I gave up a little bit of that, but now that it's holding steady, I can add back to the position. And once it gets into a formation event where I see the crest, I go, okay, I'm going to get out. It's time to pull back, and then I'm going to wait for that floor. Now, Google, typical example this morning. I'm doing the pre-market report. I go, listen, Google is going to run today. It's going to run, and so what we have to do is realize that it's going to go up easily into that 634 level, and what we want to see is we want to see it come back into maybe the 15-minute low or yesterday's high, fill a little of that gap, and then we'll go in. Well, I had to reboot my system. I came in 3 candlesticks later. It's already blown out to my end target, 635. And so I look at it 636 and I go, all right, you're just going to have to sit and wait on this one, because it's going to come back, and it's going to come back to test that 50 on the 5, because stocks do that. It was way too extended. So I sat there for 2 hours, literally, almost 2 hours, maybe an hour and 40 minutes, before it came into the 50 on the 5, and I said, all right, I'm going in, and took it to the 632 level because I was getting ready to come in here. Would have left part of it on as I see it come into 634. That's what I want to see. And if it holds that level, it's going to go, back up to 636 and then continue moving forward. So yeah.
Yeah, I think in the NEPICS world, we call them in our systems add-on trades. We have re-entry trades, and then we have something called get bob trades, which is basically just get back on board. And so definitely big believers in that as well. It's almost like you're asking the market to prove itself before you're kind of willing to go in full bore. But at the same time, like you mentioned, I think you also talk a little bit about trailing stops and how you're not a huge fan. I think I read that right.
Yes.
Of trailing stops, more of a scale in, scale out. I guess what's the what did trailing stops ever do to offend you?
Well, here's the thing about the trailing stop. Now, long ago, a couple years back, maybe 2009, 2010, the trailing stop wasn't that bad. But we live in an environment where the market is so volatile that if you've got a trailing stop, you're sure to get blown out of your trade. Trailing stops are arbitrary, and real stops that work are based on significant lines of support and resistance. So if you want to use something arbitrary to make your trades, then you're actually saying, no, sure, I am all for arbitrary results. But if you are not for arbitrary results, then you don't need to use something arbitrary like a trailing stop. Use a stop that makes sense. So many folks use stops that go, well, 75 cents, that's it. Well, does that actually make sense? What's the low of the candlestick that broke the level? Which is what I always say. Hey, listen, you broke a level, look at the low of the candlestick that created the break. Look at the low of the wave that created the move. How strong is it? Where is it? Your stop needs to be above it or below it. You can't have something arbitrary like trailing stops. And now we choose arbitrary trailing stops because we don't understand the nature of our stock maybe, or it's just plain easier. And easier never really points to better results. Something harder in terms of analysis and using all the information that's being presented to you is really always going to reap the greater reward.
Yeah, I think we totally agree with that because we always teach, using dynamic stops, dynamic targets. I haven't really ever met somebody who uses, stubborn targets and stubborn stops who's ever successful, in the long run. If you say always on my TF trades, I'm going to go for 2 points target, 1.5 points risk, it could work for a while, but it never holds up.
No, it never does. It never does. It's actually, that is just terrible. I hear people saying that all the time. I really have to go, okay, how's that work for you? Because it really doesn't. It does not prove itself out to work.
You had mentioned also when you were talking about Google this morning and the hour and change wait, hour and 45 minutes, which got me thinking about patience a little bit in trading. I know this morning had something similar, which was it took a little bit over an hour. I trade gold and silver early, and basically just kind of sat there for an hour waiting and waiting and waiting for the setup. Now, ultimately, the reward was there, but it's not the easiest thing to do as a trader to kind of sit on your hands because, one, you feel like you're missing out. Two, it's boring as all could be, just sitting there staring at the chart. So, I mean, I know you mentioned patience is so critical. I mean, is there anything that, I don't know, anything that traders can do, or how do you convince yourself that you're just going to have to sit tight for long stretches of time when you trade?
Well, that's very hard to convince somebody to do because the level of anxiety, right, the kind of emotion that gets elicited out of us when we see a gigantic candle that's moving with force, we automatically go, oh my gosh, I'm missing out, right? It's like running after a train or something. You don't, you have to be in more control of your autonomic system. And by that I mean the best trader understands that visceral, that thing from the gut that makes us go, oh, I gotta go. You've got to learn to hear that and feel that and go, wait a second, what are you doing? What are you doing? How are you exposing yourself to risk? And the main thing that helped me along the way, because I was very, very impulsive and I did not realize I was being emotionally manipulated by the sight of the candles, right? I was manipulating myself and, just looking at it going, oh no, I gotta go, I'm missing out or whatever. And it would make me buy at the high and sell at the low, just every single time. And so the thing I had to say to myself was, all right, you've got to put some boundaries in place. And the boundaries affect the psychology of making decisions. And most of us are impulse decision makers. I think I'm going to eat that. What are you going to eat, sir? Well, I think I'll have this. Or something. Everything that we do has a general impulsive nature to it, except for some very key elements that we might really focus a lot of time on. But in general, we don't do that. So we have to realize that A, we are impulsive about making decisions, and then B, we have to understand that the more controlled we are about making decisions, the less likely it is that we make poor decisions. And so it just took me really getting punched in the face with a bunch of brass knuckles over and over and over again before I finally went, no, you probably need to wait on that. And then to understand that, hey, you have a system that works, just wait for it. Just wait for it. See, many times we are correct about a setup, we don't wait for it, we get smacked, we leave, and we start looking at another stock, and we never come back to see whether the actual setup worked. Or when we do come back, we go, man, look what the market did to me. La 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 la. I was right all the time. We don't think about, well, okay, if you're right, how could you have done that better? Many of us don't really take the time to move into that secondary level of analysis that makes us go, oh, see, you shouldn't do that. You should wait. And realize this, if you miss it, if you wait and you miss it, we've got a buffet with 14,000 items sitting on it. There's going to be something else to eat. Just hang out, right? It is not a horse race. It is not a horse race in, a 60-second sprint. Not at all. This is a business that takes calculation and patience and perseverance. And so if you miss this one, don't worry. There's another one coming.
Yeah, it's like it's not really breaking news that the markets are actually going to trade again tomorrow.
Yes,
they will
exactly.
be there for all of us.
Exactly.
I would assume that, you also have some sections which maybe weren't always maybe wasn't the easiest chapter to put together, and that was on trade journaling and coming to some of these realizations, I guess, in your trading. It sounds like you had to do a lot of sort of self-discovery. And you reprinted some of those passages, and I'm sure it wasn't easy because it was an admission basically of, what, I kind of screwed a lot of things up in my trading, and you were actually well beyond just, being a little bit upset about some trade results. I mean, it seemed to hit you physically and even emotionally. You were defeated really at one point.
Yes.
In your journals. I mean, you get to that point. I think all traders, we get to that point. I mean, I thought about quitting many, many times. What was the breakthrough moment, or how did you come out of sort of the dark despair a little bit, and what turned it around for you?
Very, very good, interesting question, and really, it is very true that it was the most difficult thing for me to write in the book, and the most difficult thing for me to replicate, because it was really like I was filleting myself open and saying, "No, have a look," and it was extremely uncomfortable. But I thought to myself, what's the nature of this book? It's to actually show that reality. And what happened to me was I said, you know what? Your brain is so jumbled up right now, you've just got to take a break. And so at my threshold of, the worst trading day of my life was I traded the ISRG earnings a couple years ago, 3-4 years ago, totally on one side. I was long, and I was long via naked puts, and it was, I don't know, the stock was $300 at the time. I had a humongous delta and was down tens of thousands of dollars at the open, and it just kept running. And after that day, I went, okay, I am just about destroyed. I took some time off, and I said, all right, either you quit or you figure out what you're doing wrong, because you are doing something wrong, Anne-Marie. So figure it out. And so I stepped away and I said, all right, do you have the emotional stability to manage through the second part? Do you still have the will to win? And I deemed that I did. And then I said, all right, you've got to start at ground zero and start picking every single thing apart that you do. And so I said to myself, you can't go back in with baggage. You have to just come in clean. And so I took 2 weeks off, and I said, you know what? You're going to give yourself a break. When I came back, the first thing I did was turn off the ding that said you have a trade, because all my trades were so bad that I would hear a ding and I would get sick to my stomach. Truly Pavlovian. I'm not kidding you. And so the first thing I did was shut that off. I said, you're not going to have that kind of visceral event happen to you. You're going to shut that off. And then I went straight back to paper trading and started from scratch.
Yeah, I mean, I think it's I think everybody, I know when we do like surveys and we have new people come to us, typically at that point about 92% say that they're not trading profitably, and 8% are, and so it's usually the overwhelming number of people who aren't. And I think anybody who's finally gotten to that 8% or that success point does hit that low point? You know, it's kind of how do you respond, you know, off of that? I would assume a lot of the motivation also for you is you're just, you know, passionate about trading. I mean, do you think you can be just passionate about making money and not really that passionate about the markets and still
No
make it?
way.
Yeah.
No way. You cannot do this job just for the money. I am totally convinced. Or you can, but you're going to burn out. It's just like being a physician or anything else. You know, you've got to love some element of the game, or it's going to destroy you emotionally. It's too difficult.
Yeah, and I think some of that you probably have to sort of figure out, like you mentioned, kind of what works for you. I know, like me personally, I always turn off my P&L in real time, and I've had people sort of observe my trading, and they're like, you know, Mark, you don't know what you're making on that trade, and I'm like, yeah, I don't know what I'm losing either, and I don't want to know. I want to just execute my plan, and it's going to work out the way it's going to work out. And so for me, I know psychologically, I turn off the sounds because I don't want to hear stop out or hit target. I don't want to hear any of it. It's just,
That's
you know,
so
those are
funny.
for me, they influence me.
I'm exactly the same way. I am exactly the same way. Here's my philosophy. Go after the execution of the perfect trade and the money is
Right.
going to follow you.
Yep. Yep. I would agree with that. One last question, then we'll sort of jump into some questions here too. Is do you still, you know, get angry and frustrated with the markets, specific trades, or have you found this, you know, Zen-like balance, you know, when you trade day to day? I know my answer, but I'm curious on yours.
You know, I don't get angry with the market. I get angry with myself
Okay.
because I can see when things are becoming unstable. And I have a choice. Hey, just wait it out. You know, it's going there. And then it'll just come back and hammer me. And so I'll be very mad. Or I won't be paying attention, and then, you know, I'll get mad at myself there. I don't normally get mad at the market because I know that the market's always trying to take my money.
Right. It's a conspiracy, I tell you.
Exactly.
Yeah, I'm with you on that. So let's go to a few questions. I've got some that are in here now, and of course, if you have some that you want to ask Anne-Marie, this would be the time. So I'll just sort of kind of read these in real time. So we'll see how these go. From Mahesh, he goes, the interview is already really good. I'd like to get a copy or download it once it's over. So Mahesh, as we get towards the end, I'll put up a link where you can go. And we'll have the replays posted there as well as the podcast that we do. We'll take an excerpt of the interview and put it in there for you. So we'll make sure that we get that out. Tim says, I've read your book and it's on my short list of valuable trading books. That's nice to say for Anne-Marie. Thanks for writing it. So Tim has two questions related to the moving average trade long. Okay, we're going to get specific now from Chapter 8. But the question applies to both long and shorts. How do you filter crossover trades that roll back on you? For example, not enough volatility or follow through and the market goes range bound after entry. So basically talking about the crossover that you talk about, I guess, you know, what do you do when it fails? Or two, are there further confirmations that you need besides obviously just the crossover?
Well, there's always more than the crossover, right? And here's the rule of thumb. The steeper the slopes, the more important the crossover.
Right.
The flatter the slopes, the less important the crossover. Now here's what happens. It happens invariably. We get a crossover, things look great, we jump in the trade, and all of a sudden all the momentum falls out of it, and it stays flat. Two things that you need to look at. Look at those candles. Are they making higher highs? Are they making higher lows? Or are they truly range-bound? If they're truly range-bound, open up that stochastic momentum index. That stochastic momentum index, I use the parameters 8 and 15. Those are the 8 and 15 levels. If you are in a flat space and you see that stochastic trending sharply in one direction or another, it's probably going to resolve in that direction. And so that should give you an essence about whether to get in or get out. But that happens to all of us. That's a peril. Remember, a setup, a good setup, still has a probability of loss and failure associated with it. There is no sure thing in the market except it's going to go up and down, and you're probably going to lose money. That's the only sure thing you can think about, but that's what I would suggest doing if that happens.
Right. So you put the odds in your favor, but at the same time, it's certainly no lock or no guarantee. He also, part two of it, just asked a little bit about the exit, because he's talking about waiting for the cross back over of the 820 for a component to exit. You know, you can give back a lot of profit. I guess besides, let's say you got that positive crossover, you buy, everything seems to be okay. I mean, what do you typically use for your bailout point besides waiting for a cross the other way?
Oh, I never wait for a cross the other way well, maybe to completely close out the position, I will do that. But my Fibonacci's help me decide what it is that I'm going to do there. And just remember this. In order for a crossover to occur, you must always have worked through an essence of either a breakdown of support or a breakout of resistance. If you look at any chart and you're looking at your crossover and you see that crossover, if you look to the left, you will notice that your stock has broken. If it's a crossover to the upside, you'll notice that your stock has broken out of a resistance level, come back to test that resistance level and broken out again, or just plain broken out of the resistance level. So the price breakout is actually what happens first, and the crossover comes second, because crossovers are lagging indicators.
Right.
Price comes first. So if you say to yourself, okay, I took the crossover trade, here I am, look to the left for that support and resistance. If you fail it, guess what happened? You have failed the breakout. And if you fail a breakout, what does that mean? That means a long trade is not going to be good anymore. So you look for the series of wicks or candlesticks that held that resistance level or held it as new support for a time, and then when those wicks disappear, you've got to get out.
Yeah, I mean, that's the way I interpret it. So I would say to Tim, maybe go back over that chapter, because I think you were very clear on, you know, the failure points, and the crossover back the other way to me was more the indication that that whole move is over and any kind of scaling in or scaling out is over, but not a place that you would wait that long to get out. It's obviously way too late.
Exactly.
Let's see, Alan says, okay, well, actually, Asim says, what's a TF? So I don't know if we probably defined it later on, but it's the Russell E-mini futures. So like the S&P, like the Dow, like the NASDAQ, the TF is off of the Russell 2000 index. So that's what that is. It's a favorite of a lot of day traders. Alan says, if a trader has a basic understanding of trading stocks, Forex, and options, how would you suggest learning more regarding futures? I am in the process of searching for the trading vehicle or vehicles that best fits my personality. Nice interview, thanks. So basically he's got some experience in trading in stocks and Forex and options, but not really in futures directly, so I guess wanting some guidance there.
Okay, here's the general thought. When I talk to folks that are just futures traders, what they say to me is, you know, I just don't want to go hunting for something to trade. I don't want to go searching 50 lists. I just want to stick on my one thing, and that's what I do. So if you want to get extremely focused, then, you know, that might be something that you want to do. Here's the thing, though. If you just trade one instrument, there are going to be some days you just need to close up shop and go ride a bike or sit out in the sun or read a book or whatever it is that you like to do, because some days those vehicles are too dangerous to trade. Too whippy, no form, no function, all over the place, gigantic wicks. And so that's just something that you're going to have to say, hey, listen, if I focus on this one instrument or these two instruments, I'm going to have to realize that I can't play there every day. And for a lot of folks that I know, if they get into the futures market, they end up loving it, absolutely loving it, because there's one thing they have to study. There's no analysis that they need about fundamentals, about anything else. They can just have raw technical momentum moving them in and out, and that's all they want. So ask yourself those questions first. And if you feel like, hey, you know, I wouldn't mind that, then start focusing on the futures market.
Yeah, we actually encourage a lot of people who are trading specifically in Forex to really at least take a look at futures, because you've got the centralized markets, you've got certain liquidity advantages, commission advantages, so there's definitely a lot of opportunity there. We have a few questions on I believe you called it the stochastic momentum indicator, but a few people asking again what the name of that indicator was and then what your settings are. So maybe go back over that real quick.
Okay, the stochastic momentum index is part of the thinkorswim. Whoa, look at the bonds. Sorry, part of the thinkorswim group of trading mechanics. Now, to be very honest, I know it's particularly different to a regular relative strength index, but not quite sure how different it is. I just know it measures momentum. And so if you want to look for a momentum oscillator versus a strength index, and you don't have the stochastic momentum index, a weaker derivative might be the Chandi momentum oscillator. Here's the problem. Price is the thing that pays. And so if you get into these very technical esoteric indicators that are derivatives of other indicators, it's just sort of like watering down the tea, right? You can't really, the indicators that give you the most information about price are going to be the ones that are the best for you. And so I find the stochastic momentum index to work very, very well. Again, the parameters I use are 8 and 15. Now, let me explain something very quickly about stochastics. Stochastics, in my book, or MACDs, that sort of thing, do not measure actual oversold and overbought levels, because things can stay oversold and overbought for a long time. What they do measure are trending strengths. And if you look at a stochastic and it's sitting up pegged at 50 for months, like Google used to be forever, it's in a trend. And so when you have negative dips in a trending space, it's a pullback into support. And so many folks will see that dip, oh, it's a negative 70, that means I'm going to buy here. It starts inflecting, and they buy because it's sitting at what people say are oversold, and it immediately reverses, or it reverses just a couple of days later and goes even deeper down, because they fail to realize that it's really not a measure of being oversold or overbought. It's a measure of trend. And so I urge you to read more about the indicators that you decide to use for yourself, because you can really use just one or two, maybe three, certainly one or two only that are subgraphed, and learn a great deal about what's going on with your charts. But I like it a lot. Take a look at it. It works really, really well.
Yeah, I think it's like a trading rite of passage to attempt to trade the stochastics or the RSI on, the oversold, overboughts. We all do it early on in our trading, and we all end up losing a lot of money, because the problem is it's right some of the time, and when it's right, it's dead on. It's so accurate, but then you sort of look past when the market goes, like you say, on a tear or on a trend for an extended period of time, and you just give back everything you possibly could have made, and then some. So that's a good point. You have to understand really what the indicator is saying about the market as well. Mona is asking, what time frame do you use to place your fibs? Day, week, etc. I guess she just wants a little bit, and it's something that's really in the book. You talk a lot about, sort of the ranges that you should use to determine, where your fib measurement should be. But maybe if you can just sort of give us a bit of a top-level answer on that.
That really is based on if you're looking at a day or a swing trade, right?
Sure.
And how long you expect a day or swing trade. So if you are thinking to yourself, you know what, I'm getting myself a portfolio that I don't want to babysit, and I'm going to look at, at the end of every week or whatever, then you use a monthly chart and you build your fibs from that level. If you are day trading, then You know, I like to use the 4-hour chart because it gives me that big picture event. And then when I take a look at that big picture event and I see, you know, something developing, then I can look at that smaller time frame and go, well, wait a second, am I taking like a stop over here to the left to see if this is going to just stall out here or whatever? But, you know, that sort of thing is really dependent on framing. But really the question really exposes the fact that many of us don't know what time frames we want to trade, nor do we really have a really deep grasp of saying, okay, if I trade this time frame, what do I need to watch for? And so if you are day trading, I would say easily you need to look at the hourly charts. I look at the 4-hour charts because they always help me do the big framing, but I will look at the 4-hour charts, and then if I'm in the middle of the trade, I consistently look at the 30-minute chart and the 5-minute chart.
Yeah, and I think I have another follow-up question on the Fibonacci's, talking about, you know, have you had success using fibs on short time frames like 3 and 5 minutes? And I thought there was a place there in the book where you mentioned that's almost too quick, or that you almost get noise at all the levels more than anything. Is that do I remember that correct?
Yes, and that is true. Here's the thing. A lot of people trade very short time frames extremely well, but they are not people that contemplate, to consider, to evaluate, to discuss whether it is that they're going to move in one direction or another. Extremely decisive and usually quite experienced. Now, I don't really like drawing fibs on a 5-minute chart. I don't do it. Do they work? Absolutely. But do I have the speed to move in and out for 12 cents? Probably not. I mean, sometimes I do, but most of the time I don't. I don't have the bandwidth for that with everything else that I'm doing during the day. So you have to say, well, wait a second. Obviously it works in any time frame because the market is fractal. The question then becomes, well, when do I do that? And if I can do that, am I actually capable of doing that? And then just like earlier today, we were looking at an ABCD pattern in Google. It hit the top of the pattern and reversed like it should have, came directly into a support region, right, which was that 50 on the 5, and then began to move forward. Now, a normal ABCD pattern will, if it's on a great big time frame, it's going to give us the beginnings of some much larger pullback. But on a 30-minute time frame, it's only going to give us an hour and a half of pullback. Right? So it really, you've got to figure out, hey, if I'm structuring this, where am I going? Can I go to my target and get out? So the faster you are at making good decisions, not decisions, but good decisions, the shorter the time frame you can use.
Yeah, that makes sense. Stephen is asking, is that stuff about fib extensions and retracements that she talked about all in the book? And it is. Anne-Marie does a really nice job of, you know, definitely covering the technical side of her system, the indicators that she uses, the settings that she uses, what she looks for. I mean, it's not laid out to be, that was not my impression, all that, oh, this is, 100% mechanical and, set and forget. It's, it's not that type of trading, but it's definitely, the things that she uses in her day-to-day trading to kind of create that framework on when to buy and when to sell. So there are still some more questions, but we've sort of kept everybody a little bit over here. So I think we're going to start to wrap up. I do have a few quick announcements because we had some questions on replay and all that sort of thing. I also wanted to let people know that we'll be doing another author interview. These have been super popular. Obviously, we had another really great one today, and the next one up is with Richard Weissman. And you can always just go to nepix.com/ in this case, casino, which I know you talked about a little bit, Anne-Marie, because there was a part that I liked where you talked about, anybody, a new trader, anybody can walk up to a poker table and with some money and ante up, but the question is, are you going to walk away from the table, with any money? And I think that's, kind of similar to what a lot of traders do. It's easy to open an account. The question is, how many times are you going to, wipe out that account and be there to play again. So anyway, that's for next month. And then a couple quick links that you guys have. Netpicks.com/podcast is probably the main one, because we'll go ahead and once we edit this up, we'll have the replays out there, as well as the Day Trading Authority podcast, where we will feature the interviews that we do here, including Anne-Marie's. So we'll do that as well. Of course, my voice is going, so it's probably a good time. Any closing comments, Anne-Marie, for the traders, or anything that you can think of that comes to mind?
Trading is a tough business, and you just need to be disciplined and really value your money. Many of us just do not value the money that's sitting in our accounts, and so we lose it like, you know, we're throwing a glass of water down the sink. And if we just understand that and learn that the reason that people stay successful is because they manage how much they don't lose, you can stay in the game and make it. But that's very, very key. I want to thank you very much for inviting me. I've had a great time, great questions, and it was a really, really great pleasure. I'm looking forward to tuning in January.
Super. Yeah, we appreciate you taking the time. Just to let people know, if you're an Amazon fan, the book is readily available on Amazon, and through the miracle of the Kindle, you can actually be reading it about a minute from now. So those opportunities are there and are very easy to find as well. So again, thanks everybody for joining us. Good trading. Good luck with the rest of the day, and thanks again to you, Anne-Marie. We really appreciate it. Take care, everyone.
Thank you. Bye-bye.